David, this year, just the number of shares that are going to be available, the value of the companies that are planning to go public looks unprecedented. Levi's got a great reception yesterday. How should we be thinking about whether there's enough capital out there to absorb all of this supply?
It's a good question, but I'm not worried about it at all. From the buy side, not at all. Buy side perspective, tremendous amount of cash out there for these deals that are coming forward. Any kind of very, very, very large deal will go outside of the U.S. as well for additional demand to soak up that supply. So I'm not worried about it as it relates to being, overwhelming for the market at all. If we go all the way back to the 90s, we were doing 400 deals a year. In 96, I think we did 600 plus. So we've done 26 deals this year for $5 billion. It's nothing. It's sort of like the warm-up band for the concert that you're going to see. You're not even going to remember it because of everything else we got coming. It's going to be incredible, but I'm not worried about that supply-demand equation.
Larry, what's your takeaway so far from what we've seen from the companies who have gone public? I mean, Levi yesterday, founder family controlled, even though they're not involved in the management of the company, didn't seem to affect the reception. They're still working on their direct relationship with the customer. People said, fine, bought it up. What do you think?
Well, this is all kind of covered in the movie Gremlins, John. And the one thing with the Gremlins is you're not supposed to feed them after midnight, because then after midnight, the bad things happen.
It's not the only thing. You also don't get them wet. But go ahead. I make your point.
We don't want spike. The investors have just been fed after midnight, and the demand for these things, as David said, looks absolutely infinite. But at some point, they'll become a day of reckoning. And, when I listen to things like Lyft is really cheap at 5 times revenue, there are only a few times in market history in the last 40 or 50 years where people really price things on revenue. It's really all about cash flows. Stocks are the present value of future dividends. So you look at Lyft. It's valued, it looks like right now, at $1,500 a current customer. So let's say that current customer generates $300 of cash flow. A cable company would be valued at about $2,000 a customer of cash flow, but the cash flow per customer for the cable company is much higher, and the cable company sells it probably 8 to 10 times cash flow, and the cash flow is growing very, very nicely. So what we've got here is a situation that 5 years from now, people are going to be writing books about, just as they wrote books about the boom in 2000 and 01. It's going to end very badly. But before it ends badly, there's going to be a tremendous amount of financing, and you just have to go back to Ec 101. The demand for what these companies are selling is basically flat. And all we're doing is giving these companies capital, which is inevitably going to increase the supply, lower the prices, sometime or other produce disappointing cash flows when people start looking at them, and they'll be hell to pay.
And Lyft is on its roadshow right now, and it's going to a room full of investors, as we reported on CNBC, and saying, we're going to make money. We don't really know when, and we're not going to explain how, but we're going to make money. And yet there's a lot of enthusiasm and attention. How do you explain that?
Well, I mean, if you're directing that at me, Contessa, I think that growth is a terrific elixir for a lot of people. And I think there's anticipation. And it reminds me of when LinkedIn came out, right? And there had been no social stocks before that. And people were like, wow, I really want to participate in this. Even if I'm not exactly sure what I should be comping this against, I want to be in this. And it's a little like that. I think there's tremendous foundation there that we've got in the market right now that helps the IPOs. The Fed helped us a little bit this week, too. So there's going to be a lot of folks that are saying, I like the basic environment I see right now, and I'm going to participate in this out of the gate. I don't want to miss this.
Yeah, Steve Case was on Squawk this morning, and they were asking him what's the biggest difference now in the IPO market between when he came to market and now, and he said, well, we sold for 2 times revenues. Right? That says a lot about where we are.
Well, I think I went to the IPO roadshow for Snap, Carl, and it was on the 50th floor of the Mandarin Hotel. And there's an old saying in Wall Street, if you have to sit in the balcony, it's time to head for the exits. Well, there was no balcony in the ballroom. There were just the windows. And I would tell you, people were hanging out of the windows to buy this thing. It was an absolute feeding frenzy. And, of course, it ended badly. Now, a lot of them don't end badly. But if you remember when Facebook went public, public. I think it went public at 36, and the stock broke. I know we were buying the stock at 26.
Yeah, the high teens eventually.
But the allure of getting the stock, because the supply, because of the clever bankers, is so artificially constrained in the initial public offering, the allure of getting some of the stock and getting basically the sure thing of a pop is like an elixir for investors, and they inevitably, even though eventually it may prove to be bad for them, are going to keep coming back for more. And we're not inventing new tricks. We just have a different generation of investors.
Right.
David, you mentioned a distinction between apps on your phone companies and other companies that are coming to market this year. I wonder if there's, in this rush of companies coming public, some opportunities in the type that might be overlooked. What should investors be paying attention to, you think, perhaps outside of the hype cycle of the Pinterests and the Ubers, where there might be a different level of value?
Yeah, John, you're right, and thanks for bringing that up. I mean, when you look at out there, people keep asking me about the apps on my phone, those particular transactions that get a lot of media attention that are oftentimes B2C, but there's been a tremendous amount of unicorn activity in the B2B market. And there are names out there that just the typical consumer doesn't recognize, just to throw out names, no particular order or reasoning, but like a MuleSoft or an Okta, guys like that who came out. And we saw those deals perform really well. They've got great fundamentals. It's very different than what we saw in 2000 in terms of these companies are about 10 years old. They've got a business model they've been tweaking for quite some time. And so they can actually get out, hit their numbers, and perform longer term.